Hello, everyone, and welcome back. This is the State of the Markets first quarter 2023 edition. Today is February 13th, 2023. My name is Jonathan Thomas. I'm with Joe Zappia. We're with LVW Advisors. Thank you all for joining us. First things first, Joe, we got to cover the disclosures. That includes this is not meant to be investment advice, and it is for entertainment purposes only. So first, we'll start off with the asset class return slide. We usually start with this every quarter. So what happened last quarter?
Hey, Jonathan, thanks. Yeah, well, last quarter was a great quarter for most financial markets. Pretty positive way to cap off what was otherwise a pretty awful year for investors. Just sort of run through a few numbers here on this slide. What I'd ask everybody to pay attention to is the 1-year column. And you can see just about everything is red. Actually, everything is red with the exception of commodities. And what it means is that all investments were down last year. Stocks, bonds, even real estate had an awful year. We're going to talk more about it in a little while in terms of just how bad of a year it was for both stocks and bonds. But I think that the real key here is there was nowhere to hide. One of the other points I want to make, Jonathan, I think is critical is if you look at the 10-year return for U.S. stocks, small cap and large cap, specifically large cap, the returns are 12.5% per year on average for the last 10 years if you're an investor in the S&P 500. It's still an excellent return, even in spite of what was the 7th worst year for the S&P last year. And the 75 and 100-year average for the S&P 500 is somewhere around 9 or 10% a year. So the trailing decade returns for investors is still 2.5% higher than the very long-term average. And so it's been a really good time to be a U.S. stock investor. I'm a big believer in mean reversion. I think you are too, Jonathan. And over time, the S&P is going to return 9 or 10%. So it's reasonable to assume that at some point in the future, returns will be something below that to get back to that long-term average. And conversely, if you look at international stocks, international developed and emerging markets, 10-year returns are 5.1 and 1.7% a year for the last decade. So the outperformance of the U.S. stock market versus the rest of the world is historic. And who knows when this will mean revert. But again, it's reasonable to assume that at some point in time, international stocks will lead the way because they return on average just a little bit less than what the U.S. market does. In the last decade, it's just been dismal. And then, go ahead.
So one thing that jumps out at me is, bonds just gave up all of their return over the last 10 years just because of one really bad year. See the 1.1% annualized return over 10 years for bonds. It's crazy because I think prior to last year, it was like 3 or 4%, which is reasonable, right? It would have kept up with inflation, but now you look back and you say, what happened?
No question. It's definitely the number that jumps out the most.
No doubt about it. So last year, inflation was obviously the big story. But we're in the camp that inflation has peaked. Doesn't mean that it's going to come back down to maybe what it was right away immediately. But that accelerated rate of change is going to fall, right? So we're approaching like 9% year-over-year inflation at some point last year. And that number's really come down. And I think it makes sense, right? It's going to continue to come down from even where we are today, we believe, just because of things like home prices are really falling off a cliff to some degree, right? They're not going up like they were every single month, month over month, like they were a few years ago. Now they're maybe even coming down a little bit. Mortgage rates doubled over the last year. They went from like 3% to like 6 or 7%. So it makes sense. Prices are coming down. Bar prices are coming down as well with the higher cost to borrow. So it makes sense what we're seeing. I think that this should probably put an end to some of the inflationary talk. This is probably why the Fed is looking to slow down the rate of rate hikes going forward, because they see data like this and they say things look like they are starting to cool.
Yeah, and they have to. Before we started recording this video today, Jonathan and I were just reviewing some charts and some numbers, and it's amazing that a year ago at this time, the Federal Reserve had not even started raising rates, not even once. They were still sitting at 0%. They got to 0 in 2020 in the middle of COVID, and they were still at 0% a year ago. And since then, they've gone from 0% to 4.5%, probably headed to 5%. And we're looking at, just for example, the yield on 1-year bonds a year ago was 0.9%. And today that same 1-year US Treasury bond is yielding 4.9. So the Fed has raised interest rates dramatically because of the inflation that Jonathan just talked about. But it's completely reasonable and expected that inflation is going to come down. And you can see the chart on the right that the market thinks so too. 5-year and 10-year inflation expectations are 2-3%. And so the market expects inflation to come down. Inflation is coming down. And I think you're 100% right. We're past peak inflation.
Yeah. And you look at what the market's done, and I know we have charts too, but the market probably bottomed in October of last year. And you look at this chart, it kind of coincides with a little bit of that. So the market's probably pricing in a lot of that. I think so far year to date, Joe, the S&P is up about 6%. International stocks are doing even better, I think. So, we're not sure. We're not going to make a prediction, but it all kind of makes sense that maybe the market was pricing that in what we're seeing today, 4 or 5 months ago.
No question. Yeah, for sure. I think this is the big story. I don't think enough people are talking about it. I think that I know we're talking about it with our clients. We're talking about it with you. But last year was the worst year for bonds in history. These charts only go back to 1973. But if you take a look at the aggregate index and treasury bonds, it really goes all the way back to the 1700s. There's never been a year as bad for bonds as 2022. So in 2022, investment grade bonds, which would be considered bonds issued by the government or high quality corporations, dropped on average by about 15.8%. And not only was this decline the largest, but look at the scale of difference between the prior worst year and last year. The prior worst year was -5.9 and last year was -15.8. And then if you look at high yield bonds, which would just be bonds issued by companies that don't have as high a credit rating, it was the second worst year at -11.2. But this is really important because in prior videos, we've shown a chart that shows that there's a very high correlation between your starting yield and your return. And we just talked about this, right? A minute ago, the 10-year average return for bonds through the end of the year was 1.1%. And if you look at where yields were a decade ago, they weren't much higher than that because we've been in sort of this extremely artificially low interest rate period for so long. There's great opportunity here with where bonds are.
Absolutely.
And this is the stock market. So this is a slide, again, we show pretty much every quarter. I don't think it could be shown too much because what it tells me is the red negative years are the biggest drawdown during the calendar year. And then the gray bars are where the market ended each year. Okay, so you can see there's been plenty of years going all the way back to 1980 where the markets had declines of 15, 20, and 25%. In 2022, from peak in January of last year through October, which was the low, the S&P 500 had declined by 25% and ended the year down about 19% on a price-only basis. So the conclusion that I draw is, yeah, last year was no fun, but all of the news is around the stock market. What a bad year it was, a bear market, all of the losses. Last year was actually pretty typical in terms of a year when the market declines, and the inter-year decline wasn't anything historic. What was historic was what happened in the bond market.
Yes, absolutely. I mean, 2 years ago, we saw something a lot worse, but we recall that the market snapped back so quickly. This was back in 2020 with COVID when the S&P, as you see, fell 34%. It's just that this year, we didn't end up positive. We still ended up -19. So
Right.
People are feeling it a lot more now than they were 2 years ago. But this is a slide that I dug up, and I just think it's amazing, right? This looks at stock and bond performance over the last 100 years. So all of the blue lines indicate when stocks and bonds were both positive. The red lines are when stocks and bonds were both negative. Now, only 5 times in the last 100 years were stocks and bonds both negative. They were, on this chart, they're calling them black swan events, 5 times. And
Yeah. Oh, go ahead. Sorry.
95% of the time, stocks and bonds had some sort of positive diversification benefit. So when stocks are up, maybe bonds are down. That's okay, right? But when stocks are down, bonds are usually up, providing some benefit. And last year it didn't happen. It ended up being really a bad year because they were both down double digits. So it's an interesting slide.
Oh, it's very interesting, and I think this, in a nutshell, just explains why there was nowhere to hide last year, because bonds didn't provide any diversification protection whatsoever.
Yep. This one really coincides with that one, but it's slightly different, right? This is a 60-40 portfolio, so not 50-50 between stocks and bonds, but it was the third worst year ever for a 60-40 portfolio. But Joe, look at the years prior, right? 1931, 1937. I don't think you were around then. Not many of our clients were around then, right? So
Whoa,
really,
wait a minute. You think maybe I was?
well, I mean, this is the worst year of all time, right? For just about all of us, right? No one recalls really the Great Depression, et cetera. I mean, this is the worst modern day year in history for a 60-40 portfolio. So for just about everybody, this is obviously very unusual.
Yeah, and the biggest culprit, the biggest contributor to that loss was the bond market, because if bonds had been flat or even up 3 or 4%, then that 60-40 portfolio would have been down less than 10%. But instead, bonds actually didn't help. This is another chart that we really like to talk about a lot. This goes back to 1996, and it shows the S&P 500 at various inflection points. You can see at various peaks and bottoms. For example, March 24th of 2000 was the peak before the dot-com bubble burst. The market was trading at 25 times earnings. In other words, the price of the index was 25 times that of the underlying earnings of the index, and then declined to a bottom on October 9th of 2002, a couple years later, to 14 times earnings. And this is just showing you bull and bear cycles. And in October 9th of 2007, the market once again peaked, heading into the great financial crisis. And then we've really been sort of on a bull market tear, more or less, since 2008. The market increased 401% from 2008 through the peak just prior to COVID, February 19th, 2020, just about 3 years ago. Then we had that big, huge correction because of COVID. And then the market had this really very historic rally, in the sense that it went up more than 2 times over the course of less than 2 years. The S&P 500 has never gone up over 100% inside of a 2-year period in its history. And you could say that a lot of this was stimulus based, whether fiscal stimulus or monetary stimulus, but the Federal Reserve and the US government came to the rescue during COVID and added so much money to the system that we had this unbelievable rally that peaked in January 3rd of 2022. And then at that point, the market was trading at about 21 times earnings. And Jonathan and I have gone back and listened to our videos and watched them from previous quarters. And we talked about this at the beginning of 2022, just how expensive the market was. Now, we had no idea that markets would be as bad as they were last year, but no question, we did acknowledge and recognize just how expensive they were. But it's just not really the case so much anymore. At the end of the year, the S&P was trading at about 16 times earnings. It had declined about 20% from its peak, and valuations are much more reasonable. I think that you can't call the market very expensive, and nor can you call it cheap. And I think that what that means going forward is that we're probably likely to see markets act a little bit more normal.
Yeah.
This is a really great chart, in my opinion, because this is one of those things that is not obvious to investors. We talk all the time about investor behavior, and Jonathan, you highlighted something a few quarters ago about people correlating the market bottom during COVID with declining hospitalizations, and the market bottomed long before it looked like COVID was under control, and everybody was waiting for the vaccine. And by the time the vaccine was announced, the market had already rallied 20+%. This isn't something new or atypical. On average, the stock market bottoms 6 to 9 months before the earnings in the market bottom. Remember, recessions are defined by declining GDP, and typically it leads to declining corporate earnings. And so the stock market, in my view, is I always talk about price, right? So price is so important because price is determined by market participants. The stock market is really one of the best discounting mechanisms, one of the best predictors of the future. And maybe the market priced in a recession in 2023 in October of last year when it hit a bottom valuation and was down, I think 25+% from its high, and the market was trading at 15 times earnings. Maybe that was the discount. Maybe the market was telling us right then that we were going to go in recession, and since then it's beginning to look past that recession. I don't know, what do you think?
Yeah, exactly. And I think this leads into this next chart where people are just so pessimistic about the economy, the market, you name it. And there's a number of different ways to measure this. This is just one of them, looking at those people that are expecting maybe a stronger economy. And there's so many different charts, whether it's like investor sentiment, consumer confidence. Like, we could have pulled 20 different slides to highlight this. And I think people are just very bearish, very pessimistic, not too excited. But typically that correlates with pretty good forward returns, both in the market and maybe not as bad of results in the economy. I know one thing that I sometimes pay attention to with some entertainment purpose is looking at predictions or forecasts every year. So the end of every year, the beginning of every year, Barron's, some of these other magazines may put out, Wall Street's forecast for the year. And I mean, this year is probably one of the most bearish, pessimistic forecasts I've seen by a collection of these people. And the average return for expectations was like very low. It was about flat, maybe up a couple percent for the year. Some people are even more bearish than that. And normally, Joe, it's like 10%, 10%, 10%, because that's been the average return, right? It's really easy just to pick 10% return for the market. So people are very pessimistic. Typically, that's actually a good thing. So
Warren Buffett talks about how market strategists have a worse track record than a weatherman. And I think it's true. There's just absolutely no way to predict the future, but we do know that you can correlate pessimism and lower prices. They tend to go well together. The same way higher prices and greed tend to feed off each other. So one of the things that we want to talk about here, just to close out our slides, is, in spite of everything that happened last year, the annual dividends of the S&P 500 in calendar year 2022 increased by 11%. That means if you owned a basket of the S&P 500 companies, if you look at your dividend that you put in your pocket, in your bank account, at the end of the year, they were 11% higher than the beginning of the year. So in spite of all of the concerns about inflation, stocks really are one of the best ways to hedge inflation. And I think that one of the reasons why we focus on dividends is because we acknowledge that. And when you're putting money in your pocket with companies that are growing their cash flow, it increases your chances of having pretty good results.
Mm-hmm. Yeah, and this is, of course, just looking at stocks, but if you also look at fixed income and bonds, I mean, you said it yourself earlier, Joe, bonds are paying like 0, now they're paying like 4. That's a significant increase that now bonds are paying you. Of course, the value of your bonds went down over the last year, but income is definitely up for both stocks and bonds.
So what that means is we think that there's some great opportunity for investors, especially balanced investors, because instead of earning 0 on your cash, you can now earn 4. Instead of earning 1 or 1.5% on the bonds in your portfolio, you're earning somewhere between 4 and 6%. And you've got stocks trading, roughly, I don't know, maybe 15% cheaper than they were at their low last year. So, stocks are cheaper, yields are up. Everybody keeps waiting for this shoe to drop, waiting for this recession, waiting for the market to crash again, waiting for the market to break new lows. And I just don't think it's that easy. I don't think investing is that easy. I think you've got to just simply look at price and understand that, again, stocks are cheaper and yields are up. And that means that returns should generally be better for investors.
Mm-hmm. All right. In summary.
Yeah, we really hit all these points, but I guess I'll just reiterate them again and feel free to jump in. I think last year was so volatile because the Federal Reserve said inflation is transitory and they expected to raise interest rates once or twice last year. Instead, they had historic 15 rate increases, 15, 25 basis point rate increases throughout the year. Inflation came in hot and very unexpected. The market doesn't like unexpected things. And that's why we had high volatility and big declines, both in stocks and bonds. We're past peak inflation in our view. We understand where the Fed is and where they're going, and we expect volatility to be much, much lower this year. So for it to be a more typical year. The other thing I would say is simply because we may go into recession at some point this year, it probably would it's completely expected at this point. It doesn't mean stocks have to drop. In fact, we showed you a chart that explained that stocks bottom on average 6 months up to a year before it's actually clear we're in a recession. Probably the easiest thing is we're spending a lot of time at LVW. Jonathan and I are going through everybody's portfolios, and we're making sure that your cash is working as hard as it can. If you can pick up 4 or 5% on cash and short-term bonds, we're making sure that you're earning that in your portfolio. So take advantage of that low-hanging fruit. And then dollar cost average, because we just showed you investor behavior and market bottoms when we're not in recession. Dollar cost averaging, continually adding money to stocks, regardless of the news, is and will continue to be a proven way to increase your chances of success in the stock market. And what I would say is lastly, that we'll continue to just actively tax loss harvest where we can, so that whatever returns you do earn, you're pocketing as much as you can and sending as little bit of those returns to Uncle Sam in the form of taxes as possible.
Beautiful. All right. Well, thanks everybody. Thanks, Joe. Thanks for hanging with us today. And we look forward to next time.
Thanks, Jonathan. Thank you, everyone.